High income sounds like the ultimate financial goal for many people. From a young age, we are taught that earning more money will solve most problems in life. People imagine that once they reach a high salary, everything will become easier. Bills will stop feeling stressful, savings will grow quickly, and financial freedom will finally appear. But for millions of people, the reality looks very different. Someone can earn a strong income and still feel constant financial pressure. They might have a job that pays well, live in a nice place, and appear successful to everyone around them. Yet behind the scenes, they may still feel that money disappears too quickly. This situation confuses many people because on paper, everything seems to be working. The paycheck is large, the career is stable, and the lifestyle looks comfortable, but the feeling of financial security never fully arrives. One of the biggest reasons for this confusion is the difference between income and wealth. Income is simply the money you receive for your work. It is the flow of money entering your life every month or every year. Wealth, however, is something very different. Wealth is what remains after spending. It is the value of everything you own that continues to grow over time. Investments, savings, businesses, and assets create wealth because they exist even when you are not actively working. A person can earn a very large income but still build very little wealth. At the same time, another person with a much smaller salary can become financially stable by saving and investing consistently. This difference often surprises people because society focuses heavily on income. Salaries are easy to compare, easy to measure, and easy to talk about. Wealth, on the other hand, is usually private and invisible. Many people spend years chasing higher income, believing that the next salary increase will finally solve their financial stress. When they earn $30,000, they believe $50,000 will be enough. When they reach $50,000, they start aiming for $70,000 or $80,000. When they reach six figures, they believe they should feel rich, but often the same feeling remains. Money still feels tight and the financial pressure continues. One major reason this happens is something called lifestyle inflation. Lifestyle inflation occurs when spending increases at the same time as income. As people earn more money, they naturally upgrade their lifestyle. They move to a larger apartment or house, they buy a newer car, they start eating at more expensive restaurants. Vacations become more frequent and more luxurious. New subscriptions and services become part of everyday life. None of these upgrades seem extreme individually. In fact, many of them feel reasonable. After working hard for years, people feel they deserve a better life. The problem appears when spending grows just as quickly as income. If every salary increase simply creates new expenses, the financial situation does not improve very much. The numbers grow larger, but the balance stays the same. Another hidden factor is the difference between temporary income and permanent assets. A job produces income only as long as someone continues working. If the work stops, the income usually stops as well. This creates a fragile system where financial stability depends entirely on a single source.
Assets work differently. Assets can produce income or grow in value even when someone is not actively working. Investments in businesses, stocks, or real estate can generate returns over time. These returns may seem small at first, but over many years they can grow into something significant. The problem for many high earners is that they rely almost entirely on their salary. Their lifestyle becomes dependent on that monthly paycheck. If the job disappears, the entire financial structure becomes unstable very quickly. Mortgage payments, car loans, insurance, and everyday expenses still exist, but the income supporting them disappears. Taxes also play a much larger role than many people expect. When someone hears about a large salary, they often imagine the full number being available to spend. In reality, taxes remove a large portion of that income before it even reaches the bank account. Depending on the country and tax structure, a significant percentage of earnings can disappear through income tax, social contributions, and other deductions. After taxes come the major fixed expenses of life. Housing is usually the largest cost. Rent or mortgage payments can consume a huge portion of monthly income. Utilities, internet, and maintenance add even more to the cost of simply having a place to live. Transportation is another expensive part of modern life. Car payments, fuel, insurance, parking, and maintenance all create ongoing expenses. Many people upgrade their cars when their income increases, which adds another layer of financial pressure. Food, healthcare, insurance, and everyday spending slowly fill the rest of the budget. Even small purchases accumulate over time. Streaming services, online subscriptions, delivery apps, and convenience purchases may seem harmless individually, but together they can absorb a large portion of monthly income. Another factor that influences spending is social pressure. Modern culture constantly encourages people to display success through lifestyle. Social media shows images of luxury vacations, expensive homes, and designer brands. People begin comparing their lives with what they see online. Even if someone is financially comfortable, they may still feel pressure to upgrade their lifestyle in order to match what others appear to have. This psychological pressure often leads to spending decisions that prioritize appearance rather than financial stability. A nicer apartment, a more expensive car, or luxury items may create a temporary feeling of success, but they rarely contribute to long-term wealth. True wealth is usually built through slow and consistent financial habits. Saving and investing regularly may not feel exciting, but these actions create powerful long-term results. One of the most important forces in this process is compounding. Compounding means that investment returns begin generating their own returns over time. In the early stages, the growth appears small and slow, but as years pass, the effect becomes much stronger. The money earned from investments begins producing additional income, which is then reinvested to create even more growth. Over long periods, this process can transform relatively small investments into significant wealth. Time becomes the most powerful factor. People who begin investing earlier often benefit the most because their money has more years to compound. Unfortunately, many people delay investing because they believe they need a very high income first. They assume that investing only becomes important once they are already earning a large salary. In reality, the opposite is often true. The earlier someone starts building financial habits, the easier wealth becomes to build. Another key difference between income and wealth is freedom of time. High income often requires continuous work and long hours. Many well-paid professionals spend large amounts of time maintaining their careers. Their income may be high, but their time is heavily committed. Wealth changes this dynamic. When assets begin producing income independently, the dependence on a job slowly decreases. This creates flexibility. A person with strong investments may choose to work less, change careers, or take time to pursue personal interests. Financial independence is not about having the biggest salary possible. It is about building a system where money continues working even when you are not actively earning it. This shift in thinking changes how people treat income. Instead of seeing a salary as something to spend, they begin viewing it as a tool. Income becomes the fuel that builds assets. Every raise or bonus becomes an opportunity to invest more rather than simply increase lifestyle. Another important strategy for building wealth is controlling fixed expenses. Fixed expenses are the costs that repeat every month regardless of income changes. Housing, transportation, insurance, and subscriptions are common examples. Another important idea to understand is that money habits are usually more powerful than income level. Two people can earn the exact same salary and end up in completely different financial situations. One person might constantly feel stressed about money, while the other steadily builds savings and investments. The difference usually comes from daily decisions rather than dramatic financial events. For example, someone who automatically saves a portion of every paycheck begins building momentum over time. Even small amounts grow when they are invested consistently. On the other hand, someone who spends everything they earn must constantly depend on their next paycheck. Their financial system never develops stability because nothing is allowed to grow. Many people underestimate the power of consistency. They look for a single big opportunity that will change everything. In reality, most wealth is built slowly through repeated actions. Saving regularly, investing regularly, and avoiding unnecessary debt may not look exciting, but over many years, these habits create powerful results. Another challenge many high earners face is debt. When income increases, lenders become more willing to offer larger loans. Banks approve bigger mortgages, higher credit limits, and expensive financing options. While these opportunities can be useful in certain situations, they can also trap people in long-term financial commitments. Large debt payments reduce flexibility. A person may earn a strong salary but feel trapped because so much of their income goes toward loan payments. Mortgage debt, car loans, and credit card balances can consume a large part of monthly income. Even if someone earns a lot of money, these obligations can create constant pressure. Debt is especially dangerous when it is used to fund lifestyle rather than investment. Borrowing money to buy assets that grow in value can sometimes make financial sense. But borrowing money for depreciating items, luxury goods, or short-term satisfaction often leads to long-term problems. Another hidden problem is that many people measure success using visible lifestyle indicators rather than financial strength. A large house, expensive car, or luxury vacation can create the appearance of wealth, but appearances often hide the real financial situation. People who build wealth often focus on long-term goals rather than short-term impulses. They understand that financial discipline today creates greater opportunities in the future. This does not mean avoiding enjoyment entirely. A balanced financial life includes spending on things that truly matter. The key difference is intentional spending rather than automatic spending. Another concept that separates income from wealth is net worth. Net worth is the total value of everything someone owns minus everything they owe. This measurement provides a much clearer picture of financial health than income alone. A person earning a large salary may still have a low or even negative net worth if they carry large debts. Another person earning less money may have a much stronger financial position if they own valuable assets and have minimal debt. Tracking net worth helps people focus on long-term financial growth rather than short-term income changes. It shows whether financial decisions are actually building wealth over time. Another powerful strategy for building wealth is diversification. Diversification means spreading investments across different types of assets. Instead of relying on a single investment, money is placed in multiple areas, such as stocks, real estate, and other financial instruments. This strategy reduces risk because poor performance in one area can be balanced by growth in another. Diversification creates a more stable long-term investment system. Another important factor is financial education. Many people were never taught how money actually works. Schools often focus on earning income, but rarely explain investing, budgeting, or wealth building. Learning about these topics independently can dramatically improve financial outcomes. Understanding basic concepts such as interest rates, investment returns, and risk management helps people make smarter decisions. Another valuable habit is planning for the long term. Wealth building is rarely about short bursts of effort. It is about creating systems that work consistently over decades. Retirement planning, long-term investing, and disciplined saving are essential parts of this process. People who focus only on short-term income often miss these opportunities because they are constantly reacting to immediate financial needs. Another major difference between income and wealth is resilience. Wealth provides protection against unexpected events. Job loss, health problems, or economic downturns can happen at any time. Someone with strong savings and investments can navigate these challenges more easily. They have a financial buffer that allows them to adapt without panic. Someone living paycheck to paycheck, even with a high salary, has much less protection. Any disruption to income can create immediate stress and financial instability. Over time, this difference becomes extremely important. Financial resilience allows people to make better decisions because they are not constantly under pressure. Another advantage of building wealth is the ability to help others. Financial stability makes it easier to support family members, invest in opportunities, or contribute to meaningful causes. People who build wealth often create opportunities not only for themselves, but also the people around them. In the end, the difference between income and wealth is one of the most important lessons in personal finance. Income provides opportunity, but wealth provides security and freedom. A large salary can open doors, but only disciplined financial habits can turn that opportunity into long-term stability. Understanding this distinction changes the way people think about money. Instead of focusing only on earning more, they begin focusing on building something that lasts. True financial success is not measured by the size of a paycheck. It is measured by the strength of the financial foundation that supports your life. When income is converted into assets, investments, and long-term growth, money begins working for you rather than the other way around. And that is the real path to lasting wealth and financial independence.
That's all. Subscribe and like, and I will post even more interesting and useful videos about finance.